My name is Ray, and welcome back to Ray's Investment Clue Book. Today we'll talk about the money market and talk about the first section of the money market and the cash and cash equivalents that make up the market. So first of all, we talked a lot about the capital market before, and this time, and we're kind of transitioning now to the money market. The money market is basically a liquid market of cash and cash equivalents. Like they say, cash is king, and cash is king, especially in the money market. So it's basically made up of liquid, short-term, which plays into the liquid part, short-term and low risk, especially debt instruments that all fit into the notion of cash. Of course, on the other side is capital market and the assets that you can trade within the capital market. That's usually a longer-term market, and it has, of course, riskier investments and riskier instruments. Of course, cash is far less riskier than usually capital. And so capital usually such as long-term debt, equity, derivatives, things that we've talked about in previous videos. And now we're transitioning to cash and money market. So money market instruments, there are things like foreign exchange swaps, municipal notes, and most importantly, of course, the more fundamental parts of it are money funds, federal funds, CDs, certificate of deposits, foreign exchange swaps, and repos or repurchase agreements, some of which we will talk about today. So some of the more fundamental money market instruments are treasury bills. Treasury bills are, of course, are very short term. They're usually from 182, 91, or 28 days to expiration. And treasury bills are usually auctioned weekly with a discount, meaning that they are auctioned at a price lower than their overall final yield. For instance, let's say you buy a treasury bill for $990 and you get it back 28 days later and you get paid back $1,000. So you earn $10 profit from that, and that's what I mean at a discount. And of course, it's backed by the U.S. federal government, so it's relatively low risk as well. CDs or certificates of deposits are another thing, another money market instrument. They are basically time deposit with banks. Basically, you deposit money in the bank, you earn interest on it, and you have to keep it a certain amount of time before you can withdraw it, or else you have a fee or penalty to pay. Of course, CDs. This may sound less liquid. However, there are short-term CDs or shorter-term CDs, and of course, these are highly marketable, based in the money market. These can be traded back and forth within their own secondary market. And so there are also commercial papers, which are basically just treasury bills, except they're backed by corporations instead of private corporations instead of the federal government. And so they're relatively a bit riskier depending on the type of corporation it's issued the corporate paper. So they're short term, of course, just like treasury bills. They're 270 days or less, and they're unsecured debt, so you can't. It's not exactly backed up as much. It can be defaulted on, and so. So it's somewhat more risky than treasury bills. However, if depending on the corporation, it still can be safe. And of course, lastly, repos or repurchase agreements. Today we talk about repos are basically overnight, very short-term debt. Basically, overnight debt that you return or pay back on the second day. You back up with collateral, for instance, government securities. And so, this is secured collateral that will get returned to you on the second day once you return it. Of course, there are also less common are term repos, which is not really overnight. It's, I guess, over 30 days. So 30 days payback, just very short-term debt. Just like a basic, very short-term loan. Of course, on the other side, you can also flip it to have reverse repos. So for our final clue today, just know that cash is a very important investment theme because cash is really king. They say cash is king because cash most likely it won't go away. It's most safe, and of course, obviously liquid because it's literally cash. It's the most liquid, and so money market instruments are relatively safe and a very relatively consistent cash equivalents, not just to earn returns, but also to somewhere to store your money in that you can trust to store your money in. So thank you, and see you next time.